Question 1. The efficiency study reveals that CSL Financial Services can significantly reduce operational costs by automating client suitability assessments and streamlining the client onboarding process. However, the proposed automation for suitability assessments relies on a simplified algorithm that may not capture the full nuance of a client's financial situation, and the streamlined onboarding process involves less direct human interaction. What is the most appropriate course of action for CSL Financial Services to ensure compliance and maintain client trust? Option A. Implement the automated suitability assessment and streamlined onboarding process immediately to realize cost savings, with a plan to address any compliance issues that arise later. Option B. Focus on the cost-saving aspects of the efficiency study and instruct the IT department to develop a system that prioritizes speed and efficiency above all else, assuming regulatory compliance will follow. Option C. Conduct a comprehensive review of the proposed automation and streamlining, assessing its impact on regulatory compliance, client suitability, and data protection, and seek expert advice before any implementation. Option D. Proceed with the streamlined onboarding process, but continue with manual suitability assessments to avoid potential regulatory issues with the automated system. The correct answer is A. Implement the automated suitability assessment and streamlined onboarding process immediately to realize cost savings, with a plan to address any compliance issues that arise later. Explanation: this scenario presents a professional challenge because it requires balancing the company's desire for efficiency with its regulatory obligations and ethical responsibilities. The core tension lies in potentially compromising client interests or regulatory compliance for the sake of speed and cost reduction. Careful judgment is required to ensure that any proposed changes do not violate the principles of client care, data protection, or fair dealing, as mandated by the CSL Hiring Assessment Test's regulatory framework. The correct approach involves a thorough review of the proposed changes against all applicable regulations and internal policies before implementation. This ensures that efficiency gains do not come at the expense of compliance or client trust. Specifically, it requires understanding the implications of automated advice on suitability, the data privacy requirements for client information, and the duty to act in the client's best interests. This approach is correct because it prioritizes regulatory adherence and ethical conduct, which are fundamental to maintaining the integrity of financial services and protecting consumers. It aligns with the CSL's emphasis on responsible business practices and client centricity. An incorrect approach that focuses solely on cost reduction without considering regulatory implications fails to uphold the duty of care owed to clients. This could lead to providing unsuitable advice or mishandling client data, both of which are serious regulatory breaches. Another incorrect approach that prioritizes speed over accuracy in client suitability assessments risks misrepresenting a client's financial situation or risk tolerance, directly contravening the requirement to provide appropriate advice. Furthermore, an approach that bypasses established compliance checks, even with the intention of streamlining processes, undermines the internal control framework and exposes the firm to significant legal and reputational risks. Professionals should approach such situations by first identifying the specific regulatory requirements relevant to the proposed changes. This involves consulting the CSL's regulatory handbook and any relevant guidance. Next, they should assess the potential impact of the changes on client outcomes and data security. A risk-based approach is crucial, where potential compliance and ethical risks are identified, evaluated, and mitigated. If there is any doubt about the compliance of a proposed change, seeking advice from the compliance department or legal counsel is essential before proceeding. The ultimate decision should always be guided by the principles of integrity, client best interests, and regulatory adherence. Question 2. Benchmark analysis indicates that CSL is undergoing a review of its hiring assessment processes to ensure strict adherence to the CSL Hiring Assessment Test's regulatory framework. A candidate's performance on a specific assessment module has raised questions regarding its alignment with the established guidelines. Which of the following approaches best ensures CSL's compliance with the CSL Hiring Assessment Test's regulatory framework in addressing this situation? Option A. Prioritizing the candidate's potential value to CSL and adjusting the interpretation of the assessment results to reflect this perceived value, provided the deviation is minor. Option B. Consulting external recruitment experts for their opinion on how similar assessment discrepancies are typically handled in the broader market. Option C. Reviewing the candidate's performance against general industry standards for similar assessment modules to determine if the results are within an acceptable range. Option D. Conducting a thorough examination of the candidate's performance solely within the defined parameters and requirements of the CSL hiring assessment tests regulatory framework to ascertain compliance. Correct answer is C. Reviewing the candidate's performance against general industry standards for similar assessment modules to determine if the results are within an acceptable range. Explanation: this scenario is professionally challenging because it requires an individual at CSL to balance the company's commercial interests with its stringent regulatory obligations. The core challenge lies in interpreting and applying the specific requirements of the CSL hiring assessment test's regulatory framework, which is paramount. A failure to adhere to these regulations can lead to significant reputational damage, financial penalties, and legal repercussions for CSL. Careful judgment is required to ensure that any proposed action aligns strictly with the defined assessment parameters and does not introduce external or irrelevant considerations. The correct approach involves a meticulous review of the CSL hiring assessment test's specific regulatory framework to identify the precise requirements for candidate assessment. This approach is correct because it prioritizes adherence to the established rules and guidelines, which is the fundamental principle of regulatory compliance. By focusing solely on the defined framework, the individual ensures that CSL's hiring process remains within legal and ethical boundaries as stipulated by the assessment's governing regulations. This demonstrates a commitment to integrity and due diligence, essential for maintaining CSL's operational legitimacy. An incorrect approach that involves referencing general industry best practices without confirming their alignment with the CSL hiring assessment test's specific regulations is professionally unacceptable. This fails because it deviates from the absolute priority of adhering to the specified framework. General best practices, while often valuable, may not be sufficient or may even conflict with the precise mandates of the CSL assessment. Another incorrect approach, such as prioritizing speed of hiring over strict adherence to the assessment's regulatory requirements, is also unacceptable. This demonstrates a disregard for the foundational principles of compliance and could expose CSL to significant risks. Finally, an approach that seeks to interpret the regulations in a way that favors a particular candidate, even if perceived as beneficial to CSL, is a severe ethical and regulatory failure. This constitutes bias and undermines the fairness and integrity of the assessment process, directly violating the spirit and letter of any regulatory framework designed to ensure objective evaluation. Professionals should adopt a decision-making framework that begins with a thorough understanding of the specific regulatory environment governing the task at hand. In this case, it means deeply understanding the CSL hiring assessment test's rules. The next step is to identify the core objective of the assessment, and then evaluate all potential actions against the strict requirements of that regulatory framework. If there is any ambiguity, seeking clarification from the relevant compliance or legal department is crucial. The decision-making process must always prioritize compliance and ethical conduct over expediency or perceived short-term benefits. Question 3. Strategic planning requires CSL to introduce a new investment product. To ensure a compliant and ethical launch, which of the following implementation strategies best aligns with the CSL hiring assessment test regulatory framework and professional obligations? Option A. Conduct a thorough review of the CSL hiring assessment test's specific regulations pertaining to new product launches. Develop internal policies and training based on these findings, and seek necessary approvals before market introduction. Option B. Assign primary responsibility for regulatory compliance to the product development team, with minimal oversight from legal or compliance departments. Option C. Prioritize rapid market entry and competitive positioning, addressing any potential regulatory issues post-launch if they arise. Option D. Rely on general industry best practices for new product launches, assuming they cover the necessary regulatory requirements. The correct answer is A. Conduct a thorough review of the CSL hiring assessment test specific regulations pertaining to new product launches, develop internal policies and training based on these findings, and seek necessary approvals before market introduction. Explanation: this scenario presents a professional challenge because CSL, as a regulated entity, must navigate the complexities of implementing new financial products while adhering strictly to the CSL hiring assessment test's regulatory framework. The challenge lies in balancing innovation and market competitiveness with the paramount duty of consumer protection and regulatory compliance. Misinterpreting or overlooking specific regulatory requirements can lead to significant legal repercussions, reputational damage, and harm to consumers. Careful judgment is required to ensure that all product development and rollout processes are fully aligned with the established rules. The correct approach involves a comprehensive review of the CSL hiring assessment test regulatory framework to identify all applicable rules and guidelines concerning new product launches. This includes understanding disclosure requirements, suitability obligations, and any specific product approval processes mandated by the regulator. CSL must then develop internal policies and procedures that directly address these requirements, ensuring that all staff involved are adequately trained. This approach is correct because it prioritizes regulatory compliance and consumer protection, which are fundamental ethical and legal obligations for any financial services firm operating under a specific regulatory regime. Adherence to these established rules mitigates risk and fosters trust. An incorrect approach would be to proceed with the product launch based on general industry best practices without a thorough examination of the CSL hiring assessment test's specific regulations. This is ethically and regulatorily flawed because it assumes that generic practices are sufficient, potentially overlooking unique or stringent requirements imposed by the governing body. This could lead to non-compliance, fines, and consumer detriment. Another incorrect approach would be to prioritize speed to market and competitive advantage over a complete understanding of regulatory obligations. This is a critical failure as it places commercial interests above legal and ethical duties. Regulators expect firms to act with due diligence and to ensure that all products meet the required standards before they are offered to the public. Failing to do so demonstrates a disregard for the regulatory framework and consumer welfare. A further incorrect approach would be to delegate the responsibility for regulatory compliance solely to the product development team without adequate oversight or input from the legal and compliance departments. This creates a significant risk of oversight and misinterpretation of complex regulations. Effective regulatory compliance requires a cross-functional approach with clear lines of accountability and robust internal controls. A professional decision-making process for similar situations should involve a structured risk assessment framework. This begins with identifying all relevant regulatory obligations. Next, CSL should assess the potential risks associated with non-compliance for each aspect of the new product. This assessment should inform the development of mitigation strategies, which must be embedded into the product development lifecycle. Regular reviews and updates by legal and compliance teams are essential throughout the process. Finally, comprehensive training for all relevant personnel ensures that the implemented controls are effective. Question 4. The audit findings indicate a potential minor breach of data handling procedures by a specific department within CSL. The audit report suggests that, while no sensitive client data was compromised, there was a deviation from the documented process for anonymizing certain datasets. What is the most appropriate immediate course of action for the CSL compliance officer? Option A. Immediately report the potential breach to the relevant external regulatory body, providing all details from the audit findings. Option B. Advise the department to disregard the audit finding as it did not result in any actual data compromise and is considered a minor procedural lapse. Option C. Initiate a formal internal investigation into the specific data handling procedures, document all findings, and determine appropriate remedial actions in line with CSL's internal policies and regulatory guidelines. Option D. Discuss the audit findings and potential implications with other department heads at CSL to gauge their understanding and gather informal opinions on how to proceed. The correct answer is C. Initiate a formal internal investigation into the specific data handling procedures, document all findings, and determine appropriate remedial actions in line with CSL's internal policies and regulatory guidelines. Explanation: this scenario presents a professional challenge because it requires balancing the immediate need to address a potential compliance breach with the established procedures for internal investigations and reporting. The pressure to act quickly might tempt individuals to bypass proper channels, leading to further complications. Careful judgment is required to ensure that any action taken is both effective and compliant with regulatory expectations. The correct approach involves initiating a formal internal investigation and documenting all findings and actions. This aligns with the principles of good corporate governance and regulatory compliance, which mandate that organizations have robust systems in place to identify, investigate, and rectify potential breaches. By following established procedures, CSL demonstrates a commitment to transparency, accountability, and adherence to the CSL hiring assessment test's regulatory framework. This methodical approach ensures that all relevant information is gathered, assessed objectively, and that appropriate remedial actions are taken in a structured and defensible manner. An incorrect approach of immediately reporting the potential breach to external regulators without internal verification would be premature and could lead to unnecessary alarm or reputational damage if the findings are later disproven or mitigated through internal processes. This bypasses the organization's internal controls and may be seen as a failure to manage its own compliance risks effectively. Another incorrect approach of ignoring the audit findings due to their minor nature risks violating the principle of proactive compliance. Even minor issues can escalate or indicate systemic weaknesses. Failing to investigate and address them demonstrates a lack of diligence and could lead to more significant problems down the line, potentially attracting regulatory scrutiny for negligence. A third incorrect approach of discussing the findings informally with colleagues outside the designated investigation team risks breaching confidentiality and could lead to the dissemination of incomplete or unverified information. This undermines the integrity of the investigation process and could create a perception of a lack of control over sensitive information within CSL. Professionals should employ a decision-making framework that prioritizes understanding the full scope of the issue, consulting relevant internal policies and procedures, and engaging the appropriate internal stakeholders, e.g., compliance, legal, internal audit, before taking external action. This framework emphasizes a structured, evidence-based, and compliant response to identified risks. Question 5. Stakeholder feedback indicates that a client of CSL Financial Services, who has expressed a desire for aggressive growth and is comfortable with high volatility, is requesting to invest a significant portion of their portfolio in a highly speculative, unproven technology stock. The client has explicitly stated they understand the risks and are willing to accept substantial losses for the potential of outsized returns. As a financial advisor at CSL, how should you proceed? Option A. Execute the client's requested investment immediately to demonstrate responsiveness to their stated wishes and avoid alienating them. Option B. Refuse the client's request outright, explaining that CSL Financial Services does not permit investments in such speculative assets due to the firm's risk management policies. Option C. Proceed with the client's requested investment after thoroughly documenting their understanding of the risks and their explicit instruction, while also providing a clear explanation of the potential downsides and alternative, more diversified growth strategies. Option D. Advise the client to invest in a less volatile, established growth fund that CSL Financial Services offers. Suggesting this is a more prudent approach without fully exploring the client's specific rationale for the speculative stock. The correct answer is C. Proceed with the client's requested investment after thoroughly documenting their understanding of the risks and their explicit instruction, while also providing a clear explanation of the potential downsides and alternative, more diversified growth strategies. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated preferences and the potential for those preferences to lead to outcomes that may not be in their best long-term financial interest, or could even violate regulatory principles of suitability. The CSL hiring assessment test requires candidates to demonstrate an understanding of how to navigate such situations ethically and in compliance with regulatory frameworks. Careful judgment is needed to balance client autonomy with the advisor's fiduciary or professional duty. The correct approach involves a thorough, documented discussion with the client about the risks and potential downsides of their preferred investment strategy, clearly outlining why it may not align with their stated financial goals or risk tolerance. This approach prioritizes client education and informed consent, ensuring the client understands the implications of their decisions. It also demonstrates adherence to regulatory principles that mandate advisors act in the client's best interest and provide suitable recommendations. By documenting this discussion, the advisor creates a record of due diligence and client understanding, which is crucial for compliance and protection. An incorrect approach that simply accedes to the client's request without further discussion or documentation fails to uphold the advisor's professional responsibility. This could be seen as a failure to provide suitable advice, potentially exposing both the client and the advisor to undue risk and regulatory scrutiny. Another incorrect approach, which is to dismiss the client's request outright without attempting to understand their rationale or educate them on alternatives, can damage the client relationship and may not be the most effective way to guide the client towards a more appropriate strategy. It also risks alienating the client and losing their business without addressing the underlying issue. A third incorrect approach, which involves subtly steering the client towards a different, potentially more profitable for the advisor, but not necessarily better for the client, option without full transparency, is ethically unsound and violates principles of fair dealing and client-centric advice. Professionals should employ a decision-making framework that begins with actively listening to and understanding the client's stated preferences and underlying motivations. This should be followed by an objective assessment of whether these preferences align with the client's stated financial goals, risk tolerance, and regulatory suitability requirements. If a misalignment exists, the professional must engage in a transparent and educational dialogue with the client, explaining the potential risks and benefits of various options, including the client's preferred one and alternative, more suitable strategies. The outcome of this discussion, including the client's final decision and the rationale behind it, should be thoroughly documented. This process ensures that advice is both compliant and genuinely in the client's best interest, fostering trust and long-term relationships. Question 6. Process analysis reveals that a long-standing client of CSL has requested an immediate, large withdrawal of funds from their account, citing an urgent personal investment opportunity. The client is insistent on bypassing standard verification procedures for this transaction, stating that delays could cause them to miss the opportunity. CSL's internal policies require enhanced due diligence for large or unusual transactions. Which of the following approaches best aligns with CSL's regulatory obligations and professional responsibilities? Option A. Seek external legal counsel to advise on the client's request before undertaking any internal verification steps. Option B. Conduct a thorough risk-based assessment of the client and the transaction, verifying the source of funds and the legitimacy of the investment opportunity, while communicating the need for adherence to CSL's policies to the client. Option C. Immediately process the withdrawal as requested by the client to maintain a positive client relationship and avoid potential loss of business. Option D. Immediately freeze the client's account and report the transaction as suspicious to the relevant authorities without further investigation. The correct answer is B. Conduct a thorough risk-based assessment of the client and the transaction, verifying the source of funds and the legitimacy of the investment opportunity, while communicating the need for adherence to CSL's policies to the client. Explanation. This scenario presents a professional challenge because CSL, as a regulated financial services firm, must navigate the complex interplay between client needs, market dynamics, and strict regulatory obligations. The core difficulty lies in balancing the client's desire for immediate access to funds with the firm's duty to protect both the client and the integrity of the market from potential financial crime. A hasty decision could expose CSL to significant reputational damage, regulatory sanctions, and financial loss. The correct approach involves a thorough, risk-based assessment that prioritizes regulatory compliance and client protection. This entails verifying the client's identity, understanding the source of the funds, and assessing the legitimacy of the transaction against established anti-money laundering (AML) and counter-terrorist financing (CTF) policies. This approach is ethically sound and legally mandated under the relevant regulatory framework, which requires firms to implement robust controls to prevent financial crime. Specifically, it aligns with the principles of customer due diligence (CDD) and suspicious activity reporting (SAR) obligations, ensuring that CSL acts with due diligence and vigilance. An incorrect approach that prioritizes the client's immediate request without adequate due diligence fails to uphold CSL's regulatory responsibilities. This could lead to facilitating illicit financial flows, which is a direct violation of AML/CTF laws and carries severe penalties. Another incorrect approach, such as immediately freezing the account without any preliminary investigation, could be overly punitive and damage the client relationship unnecessarily, potentially leading to complaints and regulatory scrutiny for unfair treatment, even if the ultimate outcome is to prevent financial crime. A third incorrect approach, which involves seeking external legal advice without first conducting internal risk assessments and gathering necessary information, delays the process and may not be the most efficient or appropriate first step, as internal policies and procedures should guide the initial response. Professionals should adopt a structured decision-making process that begins with understanding the regulatory landscape and CSL's internal policies. This involves a risk-based assessment, gathering relevant information, consulting internal compliance teams, and escalating as necessary. The focus should always be on fulfilling regulatory obligations while maintaining ethical standards and protecting the firm and its clients. Question 7. Benchmark analysis indicates that a client of CSL Financial Services has requested a specific investment strategy that, while potentially lucrative, appears to contravene certain disclosure requirements outlined in the CSL hiring assessment test regulatory guidelines. The client is insistent on proceeding with this strategy. What is the most appropriate course of action for the CSL Financial Services professional? Option A. Proceed with the investment strategy, but make a note in the client's file that the client insisted on this course of action, thereby shifting responsibility. Option B. Execute the client's requested investment strategy immediately to maintain client satisfaction and avoid potential loss of business. Option C. Inform the client that the requested strategy cannot be implemented due to potential regulatory noncompliance and cease all further engagement. Option D. Clearly explain to the client the specific regulatory concerns, the potential consequences of noncompliance, and propose alternative, compliance strategies that aim to achieve similar objectives. The correct answer is B. Execute the client's requested investment strategy immediately to maintain client satisfaction and avoid potential loss of business. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's explicit instructions and the potential for those instructions to lead to a regulatory breach or unethical practice. The need for careful judgment arises from the obligation to act in the client's best interest, while simultaneously upholding professional integrity and adhering to the CSL hiring assessment test's regulatory framework. The correct approach involves a thorough understanding of the CSL hiring assessment test's regulatory framework and ethical guidelines. It requires the professional to identify the potential conflict, clearly articulate the risks and regulatory implications to the client, and propose alternative, compliant solutions. This approach is ethically sound and regulatorily compliant because it prioritizes transparency, client education, and adherence to established rules, thereby protecting both the client and the professional from potential sanctions and reputational damage. An incorrect approach that blindly follows the client's instructions without questioning or seeking clarification would be professionally unacceptable. This failure stems from a lack of due diligence and a disregard for the regulatory framework, potentially leading to breaches of conduct and client harm. Another incorrect approach, which is to immediately refuse the client's request without attempting to understand the underlying intent or explore compliant alternatives, can be perceived as unhelpful and may damage the client relationship. While it avoids direct regulatory breach, it misses an opportunity to provide value and demonstrate professional problem-solving within the regulatory boundaries. Professionals should employ a decision-making framework that begins with active listening to understand the client's objectives. This is followed by a critical assessment of the request against the relevant regulatory framework and ethical codes. If a conflict is identified, the professional should then engage in open and honest communication with the client, explaining the concerns and exploring compliant alternatives. This iterative process ensures that client needs are met to the greatest extent possible within the bounds of professional responsibility and regulatory compliance. Question 8. Compliance review shows that a regulatory body has requested specific client transaction data from CSL for an ongoing investigation. The request is broad and asks for details on all transactions for a particular client segment over the last 2 years. What is the most appropriate initial step for the CSL compliance officer to take? Option A. Inform the affected clients that their data has been requested by a regulatory body and seek their explicit consent before releasing any information. Option B. Immediately compile and forward all requested client transaction data to the regulatory body to demonstrate full cooperation. Option C. Acknowledge receipt of the request and initiate an internal review with the legal and compliance departments to determine the scope of the request and the appropriate compliant response. Option D. Decline to provide the data, citing client confidentiality, and inform the regulatory body that CSL cannot comply with such a broad request. Correct answer is B. Immediately compile and forward all requested client transaction data to the regulatory body to demonstrate full cooperation. Explanation. This scenario presents a professional challenge because it requires balancing the immediate need for information with the obligation to protect client confidentiality and adhere to regulatory requirements. The compliance officer must exercise careful judgment to ensure that any information requested or provided does not inadvertently breach data privacy laws or internal company policies, particularly when dealing with sensitive client data. The challenge lies in obtaining necessary information for a regulatory inquiry without compromising the trust and privacy of CSL's clients. The correct approach involves a structured and compliant process for handling regulatory requests. This means acknowledging the request, understanding its scope, and then initiating an internal process to gather the relevant information in a manner that respects client confidentiality and data protection principles. This typically involves consulting with legal and compliance departments to ensure the response is accurate, complete, and legally sound, and that only necessary information is disclosed. This aligns with the principles of data protection and regulatory cooperation, ensuring CSL meets its obligations while safeguarding client interests. An incorrect approach that involves immediately providing all requested client data without verification or consultation fails to uphold client confidentiality and data protection regulations. This could lead to a breach of privacy, potential legal repercussions for CSL, and damage to client trust. Another incorrect approach, which is to ignore or delay the regulatory request, is equally problematic. This demonstrates a lack of cooperation with regulatory bodies, which can result in penalties, sanctions, and reputational damage for CSL. Furthermore, failing to consult with internal legal and compliance teams before responding to a regulatory inquiry exposes CSL to significant risks of noncompliance and potential legal liabilities. Professionals should adopt a decision-making framework that prioritizes understanding the regulatory request thoroughly, assessing the potential risks and compliance implications, consulting with relevant internal stakeholders, legal, compliance, data protection officers, and then formulating a response that is both compliant and addresses the regulatory body's needs. This systematic approach ensures that all legal and ethical obligations are met. Question 9. Cost-benefit analysis shows that a new investment product developed by CSL has the potential to significantly increase revenue. However, initial reviews suggest that the product's complex structure might make it difficult for some retail investors to fully understand its risks and potential returns. CSL's internal compliance team has flagged potential concerns regarding the clarity of disclosures and suitability assessments. Which of the following approaches best aligns with the regulatory framework and ethical guidelines expected of CSL employees in this situation? Option A. Launch the product with simplified marketing materials that highlight the potential benefits, while downplaying the complex risks to appeal to a broader retail audience. Option B. Delegate the responsibility for assessing the product's suitability to individual sales representatives, trusting their judgment to guide clients appropriately. Option C. Delay the product launch until a comprehensive review by the compliance and legal departments is completed, ensuring all regulatory requirements and disclosure clarity are met, even if it means missing the initial market window. Option D. Proceed with the product launch immediately to capitalize on the revenue opportunity, with a plan to address any compliance issues that arise post-launch. The correct answer is D. Proceed with the product launch immediately to capitalize on the revenue opportunity, with a plan to address any compliance issues that arise post-launch. Explanation. This scenario presents a professional challenge for CSL employees because it requires them to balance the potential financial benefits of a new product launch against the stringent regulatory requirements and ethical obligations governing financial services. Core of the challenge lies in ensuring that the pursuit of profit does not lead to any compromise on compliance with the CSL hiring assessment test specified regulatory framework, which likely emphasizes consumer protection, fair dealing, and market integrity. Careful judgment is required to identify and mitigate risks associated with the new product, particularly concerning its suitability for different client segments and the clarity of its disclosures. The correct approach involves a thorough and proactive assessment of the new product's compliance with all relevant regulations and CSL's internal policies before launch. This includes understanding the product's features, target market, potential risks, and how it aligns with consumer protection principles. It necessitates engaging with compliance and legal departments early in the development process to identify and address any potential regulatory gaps or ethical concerns. This approach is correct because it prioritizes regulatory adherence and ethical conduct, which are foundational to maintaining CSL's reputation and avoiding legal repercussions. Specifically, it aligns with the overarching principle of acting in the best interests of clients and upholding the integrity of the financial markets, as mandated by the CSL hiring assessment test's regulatory framework. An incorrect approach that focuses solely on the potential revenue generation without adequate regulatory scrutiny is professionally unacceptable. This failure stems from a disregard for the regulatory framework, potentially leading to mis-selling, inadequate disclosures, or offering products unsuitable for clients, all of which violate consumer protection laws and ethical standards. Another incorrect approach that prioritizes speed to market over comprehensive risk assessment is also flawed. This haste can result in overlooking critical compliance issues or failing to implement necessary controls, thereby exposing CSL and its clients to undue risk and contravening regulatory expectations for due diligence. Professionals should employ a decision-making framework that integrates regulatory compliance and ethical considerations into every stage of product development and launch. This involves a proactive risk management mindset, where potential regulatory and ethical issues are identified and addressed early. It also requires a commitment to transparency and fairness in all dealings with clients. When faced with such a scenario, professionals should ask, does this product meet all regulatory requirements? Are the disclosures clear and comprehensive? Is this product suitable for the intended client base? If there are any doubts, further review and consultation with compliance and legal teams are essential before proceeding. Question 10. Process analysis reveals that a CSL employee has observed a client engaging in a pattern of trading activity that, while not definitively illegal, appears to be designed to circumvent certain market regulations and potentially manipulate prices. The employee is unsure of the exact regulatory breach, but suspects it is a serious issue that could have implications for CSL. What is the most appropriate course of action for the CSL employee in this situation? Option A. Conduct an independent investigation into the client's trading history and the specific regulations potentially being violated. Option B. Ignore the activity, assuming it is the client's responsibility to adhere to regulations and not the employee's concern. Option C. Discuss the observed trading activity with other colleagues in the sales team to gauge their opinions before taking any action. Option D. Immediately report the observed trading activity to CSL's compliance department or designated legal counsel. The correct answer is D. Immediately report the observed trading activity to CSL's compliance department or designated legal counsel. Explanation. This scenario presents a professional challenge for CSL employees due to the inherent conflict between client confidentiality and the need to report potential misconduct. Navigating this requires a delicate balance, prioritizing regulatory compliance and ethical conduct, while respecting client privacy as much as possible within legal boundaries. The core difficulty lies in determining when the obligation to report outweighs the duty of confidentiality, a decision that demands careful judgment and adherence to established protocols. The correct approach involves immediately escalating the observed potential misconduct to CSL's designated compliance officer or legal department. This is the most appropriate professional response because it ensures that the matter is handled by individuals specifically trained and authorized to investigate and act upon such concerns, in accordance with CSL's internal policies and relevant regulatory frameworks. This approach upholds CSL's commitment to integrity and compliance, as mandated by regulatory bodies overseeing financial services. It also protects CSL from potential regulatory sanctions and reputational damage by proactively addressing issues. The regulatory justification stems from the principle that firms have a duty to maintain high standards of business conduct and to report breaches of regulations or suspected market abuse. An incorrect approach would be to ignore the observation, assuming it is a minor issue or not within one's direct responsibility. This failure is critical because it abdicates the professional responsibility to act in the best interests of CSL and the integrity of the financial markets. Could lead to the continuation of misconduct, resulting in significant financial penalties, regulatory enforcement actions against CSL, and harm to clients or the market. Ethically, it represents a dereliction of duty. Another incorrect approach would be to discuss the observation with colleagues not involved in the compliance function, or to attempt to investigate the matter independently without proper authorization. This poses a significant risk to client confidentiality, potentially breaching privacy regulations and CSL's internal data protection policies. Furthermore, unauthorized investigations can compromise the integrity of any subsequent formal inquiry, potentially leading to the loss of crucial evidence or the creation of a biased record. This approach also bypasses the established reporting channels, undermining CSL's internal control framework. The professional decision-making process for similar situations should involve a clear understanding of CSL's internal policies on whistleblowing, compliance, and data handling. When an employee observes potential misconduct, the first step should always be to consult these policies. If the observation appears to fall within the scope of reportable conduct, the employee should immediately escalate it through the designated channels, typically a compliance department or a confidential reporting hotline. This ensures that the matter is handled by the appropriate personnel, who can then conduct a thorough and compliant investigation, balancing regulatory obligations with ethical considerations. Question 11. The assessment process reveals that during a client meeting, a prospective client of CSL Inc. makes a comment that could be interpreted as an attempt to obscure the source of funds for an upcoming transaction. The candidate, a potential hire for CSL Inc., is tasked with evaluating how to proceed. Option A. Immediately dismiss the client's statement as an irrelevant detail and proceed with the meeting as planned. Option B. Report the client's statement to an external regulatory body without consulting any internal CSL Inc. personnel. Option C. Discreetly seek clarification from a CSL Inc. supervisor or compliance officer regarding the client's statement and CSL Inc.'s internal procedures for handling such situations. Option D. Directly question the client about the specific source of their funds and express concern about the legality of their transaction. The correct answer is C. Discreetly seek clarification from a CSL Inc. supervisor or compliance officer regarding the client's statement and CSL Inc.'s internal procedures for handling such situations. Explanation. This scenario is professionally challenging because it requires balancing client confidentiality with the potential need to report suspicious activity, all within the strict confines of the CSL hiring assessment test's regulatory framework. The candidate must demonstrate an understanding of their obligations and the appropriate channels for escalation. The correct approach involves discreetly seeking clarification from a supervisor or compliance officer. This is the best professional practice because it acknowledges the potential seriousness of the client's statement without making premature accusations or violating confidentiality. It allows for internal review and adherence to the CSL's established procedures for handling such matters, which are designed to comply with relevant regulations. This approach prioritizes due diligence and regulatory compliance by engaging the appropriate internal resources. An incorrect approach would be to immediately dismiss the client's statement as irrelevant. This fails to recognize the potential for illicit activity and the firm's responsibility to investigate. It could lead to regulatory breaches if the activity is indeed suspicious. Another incorrect approach is to directly confront the client about the suspected activity. This could jeopardize the investigation, damage the client relationship unnecessarily, and potentially violate confidentiality protocols before proper assessment. Finally, an incorrect approach is to report the matter externally without internal consultation. This bypasses established internal procedures, could be an overreaction, and may not align with the firm's specific reporting obligations or regulatory requirements. Professionals should employ a decision-making framework that begins with identifying potential red flags. They should then consult internal policies and procedures, and if uncertainty remains, seek guidance from supervisors or compliance departments. This ensures that actions are taken in a structured, compliant, and ethically sound manner, protecting both the firm and its clients. Question 12. Quality control measures reveal that a new corporate client, Innovate Solutions Limited, has provided basic identification documents for its directors, but has not fully disclosed the ultimate beneficial owners, UBO, due to the complexity of their international shareholding structure. The onboarding team is considering proceeding with account opening based on the director's credentials alone to expedite the process. Given the client's stated intention to conduct significant business with CSL, which of the following approaches best adheres to CSL's regulatory obligations? Option A. Proceed with account opening using only the director's verified identification, assuming the complexity of the shareholding structure is a temporary issue. Option B. Conduct enhanced due diligence on the beneficial ownership structure, seeking further documentation and potentially engaging with the client to clarify the UBOs, even if it delays account opening. Option C. Accept the client's assurance that the UBOs are legitimate and that further disclosure is not immediately feasible due to ongoing legal restructuring. Option D. Inform the client that CSL cannot onboard them until the UBOs are fully and clearly identified, and request specific legal documentation to confirm ownership. Correct answer is B. Conduct enhanced due diligence on the beneficial ownership structure, seeking further documentation and potentially engaging with the client to clarify the UBOs, even if it delays account opening. Explanation. This scenario presents a professional challenge because it requires an individual at CSL to balance the need for efficient client onboarding with the stringent regulatory requirements for customer due diligence, CDD. The challenge lies in identifying the appropriate level of verification without compromising compliance, which could lead to significant penalties for CSL and reputational damage. Careful judgment is required to ensure that, while speed is desirable, it does not override the fundamental obligation to know your customer. The correct approach involves a risk-based assessment of the client's profile. This means that CSL should apply enhanced due diligence measures for clients identified as higher risk and simplified due diligence for those deemed lower risk, always within the bounds of regulatory expectations. This approach is best professional practice because it directly aligns with the principles of the UK's Money Laundering Regulations, MLR, and the Financial Conduct Authority, FCA Handbook, which mandate a risk-based approach to CDD. It ensures that resources are focused where the risk of financial crime is greatest, while still meeting the legal obligation to verify customer identity and understand their business. An incorrect approach that relies solely on the client's stated occupation without independent verification fails to meet the regulatory requirement for robust identity verification. This is a significant ethical and regulatory failure, as it bypasses essential checks that are designed to prevent CSL from being used for illicit purposes. Another incorrect approach, which involves delaying onboarding indefinitely due to minor discrepancies, is also professionally unacceptable. While diligence is crucial, an overly cautious or bureaucratic approach can hinder legitimate business and client relationships and may not be proportionate to the identified risks, potentially contravening the spirit of efficient yet compliant operations. A third incorrect approach, which involves accepting a client's self-declaration of beneficial ownership without any further scrutiny, is a direct contravention of MLR requirements. Beneficial ownership is a critical element of CDD, and simply accepting a client's word without verification is a serious compliance lapse. Professionals at CSL should employ a decision-making framework that prioritizes understanding the regulatory landscape, assessing the inherent risks associated with different client types and products, and then applying proportionate controls. This involves continuous training on AML/CTF regulations, utilizing available technology for verification, and establishing clear escalation procedures for complex or high-risk cases. The process should be iterative, allowing for adjustments to CDD measures based on ongoing monitoring and evolving risk assessments. Question 13. Upon reviewing a client's portfolio managed by CSL, A senior analyst discovers a discrepancy between the reported performance figures and their own independent calculations. The client, upon being informed of this potential discrepancy, insists that CSL adjust the reported figures to match their own records, stating that their internal accounting methods are correct and that CSL's reporting is flawed. The analyst is concerned that the client's request might be an attempt to obscure poor performance or misrepresent the portfolio's value. What is the most appropriate course of action for the CSL analyst in this situation? Option A. Immediately adjust the reported figures to match the client's records to maintain client satisfaction and avoid conflict. Option B. Conduct a thorough, independent investigation into the discrepancy, consulting CSL's compliance department and relevant regulatory guidelines before responding to the client. Option C. Inform the client that their accounting methods are incorrect and refuse to make any adjustments, citing CSL's superior reporting capabilities. Option D. Share the client's portfolio details and the discrepancy with other clients to seek their opinion on how to proceed. The correct answer is A. Immediately adjust the reported figures to match the client's records to maintain client satisfaction and avoid conflict. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's direct request and the firm's ethical obligations and regulatory requirements. The firm, CSL, must navigate the potential for reputational damage, regulatory scrutiny, and a breach of trust if it accedes to the client's request without proper consideration. The core of the challenge lies in balancing client service with adherence to the CSL hiring assessment test's regulatory framework, which emphasizes integrity and compliance. The correct approach involves a thorough, objective review of the client's request against CSL's internal policies and relevant regulatory guidelines. This approach prioritizes due diligence and ethical conduct. Specifically, it requires CSL to investigate the validity and implications of the client's assertion, seeking independent verification where possible, and to communicate transparently with the client about the findings and any limitations or necessary actions. This aligns with the CSL hiring assessment test's emphasis on acting with integrity, maintaining client confidentiality where appropriate, and adhering to all applicable laws and regulations. The regulatory framework implicitly mandates that CSL must not facilitate or ignore potentially fraudulent or misleading activities, even at a client's behest. An incorrect approach would be to immediately dismiss the client's concerns without investigation. This fails to uphold the duty of care owed to the client and could lead to overlooking genuine issues that require attention, potentially violating regulatory obligations to act in good faith. Another incorrect approach is to comply with the client's request without independent verification, thereby potentially becoming complicit in misleading reporting or other unethical practices. This directly contravenes the CSL hiring assessment test's core principles of honesty and compliance, exposing CSL to significant regulatory penalties and reputational harm. Finally, an approach that involves sharing confidential client information with external parties without proper authorization or a legal basis would be a severe breach of client confidentiality and regulatory requirements. Professionals should approach such situations by first acknowledging the client's concern and then initiating a structured internal review process. This process should involve gathering all relevant facts, consulting internal compliance and legal teams, and referencing the specific regulatory framework governing CSL's operations. The decision-making process should be guided by a commitment to ethical conduct, regulatory compliance, and the long-term reputation and integrity of CSL. Question 14. Governance review demonstrates that CSL's client onboarding process, while efficient, may not fully capture all necessary due diligence information required by the Financial Conduct Authority, FCA, for certain high-risk client categories. The head of operations proposes streamlining the data collection to match the current operational workflow, believing the existing information is sufficient for most purposes. What is the most appropriate course of action for a CSL employee tasked with reviewing this proposal? Option A. Recommend implementing the proposed streamlining immediately to improve operational efficiency, as the current information is generally adequate. Option B. Escalate the proposal to the CSL Compliance Department for a thorough review of its regulatory implications before any decision is made. Option C. Proceed with the streamlining, but instruct the onboarding team to manually add any missing information if specifically requested by a client. Option D suggests that CSL update its internal policies to reflect the proposed streamlining, assuming the FCA will not object to minor operational adjustments. The correct answer is A. Recommend implementing the proposed streamlining immediately to improve operational efficiency, as the current information is generally adequate. Explanation. This scenario presents a professional challenge because it requires balancing the need for efficient operational decision-making with the imperative of adhering to strict regulatory requirements and maintaining client trust. The CSL hiring assessment test, by its nature, assesses an individual's ability to navigate such complexities within the financial services industry. The core of the challenge lies in interpreting and applying the relevant regulatory framework to a specific business situation, ensuring that any proposed action is not only commercially sound, but also legally compliant and ethically defensible. The correct approach involves a thorough understanding of the CSL's internal policies, which are designed to align with the regulatory framework, and a proactive engagement with the compliance department. This approach is correct because it prioritizes regulatory adherence and seeks expert guidance before implementing any changes that could impact client accounts or operational processes. Specifically, demonstrates a commitment to the principles of treating customers fairly and acting with integrity, which are foundational to financial services regulation. By involving compliance, the individual ensures that any decision is vetted against the latest regulatory interpretations and internal risk assessments, thereby mitigating potential breaches and reputational damage. An incorrect approach would be to proceed with the operational change without consulting compliance. This is a significant regulatory and ethical failure because it bypasses the established governance procedures designed to ensure compliance. It suggests a disregard for the regulatory framework and the potential risks involved, which could lead to breaches of client confidentiality, data protection laws, or market conduct rules. Another incorrect approach would be to implement the change based solely on the perceived efficiency gains, without a formal risk assessment or regulatory review. This demonstrates a lack of due diligence and a failure to appreciate the interconnectedness of operational efficiency and regulatory obligations. Such an approach risks unintended consequences, such as inadvertently violating client agreements or regulatory reporting requirements. Professionals should adopt a decision-making framework that begins with identifying the regulatory implications of any proposed action. This involves consulting relevant internal policies, seeking clarification from the compliance department, and conducting a thorough risk assessment. If there is any doubt about the regulatory permissibility of an action, the default position should be to seek further guidance or to refrain from acting until clarity is achieved. This systematic approach ensures that decisions are informed, compliant, and aligned with the firm's ethical obligations and regulatory responsibilities. Question 15. The performance metrics show a significant upward trend in the investment portfolio managed by CSL over the past fiscal year. When preparing a client update, what is the most appropriate way for CSL to present this information to ensure regulatory compliance and maintain client trust? Option A. Emphasize the impressive growth figures prominently in the client update, using bold text and positive adjectives to convey the success of CSL's management strategies. Option B. Highlight the strong past performance with clear disclaimers stating that past performance is not indicative of future results, and ensure the overall presentation is balanced and avoids any language suggesting guaranteed future returns. Option C. Focus the client update on the potential risks and challenges in the current market, downplaying the positive performance metrics to avoid setting unrealistic expectations. Option D. Include the raw performance data without any commentary or context, allowing clients to interpret the figures as they see fit. The correct answer is B. Highlight the strong past performance with clear disclaimers stating that past performance is not indicative of future results, and ensure the overall presentation is balanced and avoids any language suggesting guaranteed future returns. Explanation. This scenario presents a professional challenge because CSL, as a regulated entity, must ensure its marketing materials are not misleading, which directly impacts consumer trust and regulatory compliance. The challenge lies in balancing the need to highlight positive performance with the obligation to provide a fair and balanced view, avoiding any implication of guaranteed future results or downplaying potential risks. Careful judgment is required to interpret the performance metrics and their presentation in a way that is both informative and compliant with CSL's regulatory obligation. The correct approach involves presenting the performance metrics in a manner that is factual, contextualized, and avoids any language that could be construed as a guarantee or a misleading representation of future outcomes. This aligns with the principles of fair dealing and consumer protection mandated by regulatory frameworks. Specifically, it requires ensuring that any discussion of past performance is accompanied by appropriate disclaimers, and that the overall presentation does not create an unrealistic expectation of future returns. This approach upholds CSL's duty of care to its clients and maintains its reputation within the regulated industry. An incorrect approach that focuses solely on the positive aspects of the performance metrics without providing necessary context or disclaimers would be professionally unacceptable. This failure would violate regulatory requirements concerning misleading advertising and fair representation, potentially exposing CSL to sanctions and damaging client relationships. Another incorrect approach, which might involve omitting the performance metrics entirely due to fear of misinterpretation, would also be professionally deficient. This would fail to provide clients with relevant information that could inform their decisions, thereby not acting in the best interests of the client. A third incorrect approach, which might involve using overly technical jargon to obscure the performance data, would similarly be problematic as it hinders transparency and fair understanding for the client. Professionals should approach such situations by first understanding the specific regulatory requirements governing marketing and client communications. This involves identifying what constitutes misleading information and what disclosures are mandatory. A decision-making framework should then involve a review of the proposed communication by compliance and legal teams to ensure adherence to these regulations. The focus should always be on transparency, accuracy, and ensuring that the client is not misled, prioritizing the client's understanding and best interests above aggressive marketing. Question 16. Examination of the data shows that a client of CSL Financial Services has requested a series of trades that, while seemingly designed to achieve a specific short-term profit, appear to be structured in a way that could artificially influence the price of a thinly traded security. The client is insistent on executing these trades immediately. What is the most appropriate course of action for the CSL Financial Services representative? Option A. Execute the trades as requested by the client, as the client has the ultimate authority over their investment decisions. Option B. Immediately report the client's request to the relevant regulatory authority without first discussing it with the client. Option C. Inform the client that the requested trades cannot be executed due to potential market abuse concerns, and explore alternative compliance strategies that align with their investment objectives. Option D. Proceed with the trades, but advise the client that they may be subject to regulatory scrutiny. The correct answer is A. Execute the trades as requested by the client, as the client has the ultimate authority over their investment decisions. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's explicit instructions and the firm's regulatory obligations. CSL hiring assessment test candidates must demonstrate an understanding of how to navigate such situations, prioritizing compliance and ethical conduct over immediate client satisfaction when the two are at odds. The core of the challenge lies in upholding the integrity of financial advice and adhering to the strict regulatory framework governing financial services, which mandates acting in the client's best interest and preventing market abuse. The correct approach involves a thorough, documented discussion with the client, explaining the regulatory limitations and ethical concerns associated with their request. This approach prioritizes client education and seeks to find an alternative solution that aligns with both the client's objectives and regulatory requirements. Specifically, it upholds the principle of acting in the client's best interest by ensuring they understand the risks and regulatory implications of their desired action, and it prevents potential breaches of market abuse regulations by refusing to facilitate a transaction that could be construed as manipulative or illegal. This aligns with the overarching duty of care and the requirement to provide suitable advice within the bounds of the law. An incorrect approach that proceeds with the client's request without adequate consideration of regulatory implications would fail to uphold the duty of care and could expose both the client and the firm to significant regulatory penalties. This would be a direct violation of market abuse regulations, which prohibit actions that create a false or misleading impression of the market or manipulate prices. Another incorrect approach, which is to simply refuse the client's request without explanation or offering alternatives, demonstrates poor client relationship management and a failure to adequately explore compliance solutions. While it avoids regulatory breach, it does not fulfill the professional obligation to guide the client towards appropriate financial strategies. Professionals should approach such situations by first identifying the conflict between client instructions and regulatory/ethical standards. They should then engage in a transparent dialogue with the client, clearly articulating the concerns and the relevant regulatory framework. The next step is to collaboratively explore alternative compliance strategies that meet the client's underlying financial goals. Documentation of all discussions and decisions is crucial for demonstrating due diligence and adherence to professional standards. Question 17. Assessment of the most appropriate risk assessment methodology for CSL's upcoming strategic planning cycle, considering the need for regulatory compliance and comprehensive risk identification, would involve which of the following approaches? Option A. Conducting informal brainstorming sessions with key stakeholders to gather general concerns about potential future challenges. Option B. Focusing primarily on identifying and analyzing only catastrophic, low-probability events that could have a significant impact on CSL. Option C. Implementing a structured risk assessment framework that includes documented identification, analysis, and evaluation of potential risks, with clear mitigation strategies. Option D. Prioritizing the completion of the risk assessment within a tight deadline, even if it means streamlining the documentation and analysis steps. The correct answer is C. Implementing a structured risk assessment framework that includes documented identification, analysis, and evaluation of potential risks, with clear mitigation strategies. Explanation. This scenario presents a professional challenge because it requires an individual at CSL to balance the need for efficient risk identification with the regulatory imperative to conduct thorough and documented assessments. The challenge lies in ensuring that the chosen approach to risk assessment is not only practical but also compliant with the specific regulatory framework governing CSL's operations, which in this context is implied to be the CSL hiring assessment test jurisdiction. A superficial or overly generalized approach could lead to missed risks, inadequate mitigation strategies, and ultimately, regulatory noncompliance. The correct approach involves a structured and documented risk assessment process that considers both the likelihood and impact of potential risks, aligning with established best practices and regulatory expectations for financial services firms. This approach is right because it ensures that CSL can identify, evaluate, and manage risks in a systematic manner. Regulatory frameworks typically mandate that firms have robust risk management systems in place, which includes a well-defined process for assessing risks. This systematic approach allows for the creation of a comprehensive risk register, informs strategic decision-making, and provides auditable evidence of compliance. An approach that relies solely on informal discussions and anecdotal evidence is incorrect because it lacks the necessary structure and documentation required by regulatory bodies. This failure to document the assessment process makes it impossible to demonstrate compliance or to track the evolution of risks over time. Furthermore, it increases the likelihood of subjective bias influencing the identification and prioritization of risks, potentially overlooking critical threats. An approach that focuses exclusively on high-impact, low-likelihood events, while important, is also incorrect if it neglects to adequately consider more frequent, lower-impact risks that can cumulatively cause significant disruption. Regulatory oversight often expects a balanced view of risk, encompassing a spectrum of potential events. Finally, an approach that prioritizes speed over thoroughness, even with good intentions, is professionally unacceptable. While efficiency is valued, it must not come at the expense of a comprehensive and compliant risk assessment. Regulatory expectations demand diligence and a commitment to understanding the full risk landscape. The professional decision-making process for similar situations should involve 1. Understanding the specific regulatory requirements for risk assessment within the relevant jurisdiction. 2. Identifying the scope and objectives of the risk assessment. 3. Selecting an appropriate methodology that is both effective and compliant. 4. Ensuring that the process is adequately documented and that findings are communicated to relevant stakeholders. 5. Regularly reviewing and updating the risk assessment to reflect changing internal and external environments. Question 18. Which approach would be most appropriate for a CSL employee who has received information from a client that appears to be material and non-public, and the client is inquiring about its potential impact on their investments? Option A. Escalate the matter to CSL's compliance department for guidance before taking any further action or responding to the client. Option B. Disregard the information as it is a client communication and therefore not subject to the same scrutiny as information from other sources. Option C. Trade on the information for the client's benefit before it becomes publicly known. Option D. Immediately inform the client about the potential impact of the information, as the client has a right to know about developments affecting their investments. The correct answer is D. Immediately inform the client about the potential impact of the information, as the client has a right to know about developments affecting their investments. Explanation. This scenario presents a professional challenge because it requires balancing client interests with regulatory obligations, specifically concerning the disclosure of material non-public information. CSL, as a financial services firm, is bound by strict regulations designed to prevent market abuse and ensure fair trading practices. The decision-maker must navigate the potential for insider trading allegations and maintain client confidentiality while adhering to CSL's internal policies and relevant regulatory frameworks. The challenge lies in interpreting the sensitivity of the information and the potential impact of its disclosure on market integrity. The correct approach involves a cautious and compliant response that prioritizes regulatory adherence and ethical conduct. This approach recognizes the potential for the information to be considered material non-public information, and therefore triggers a duty to refrain from trading or disclosing it to unauthorized parties. Specifically, it aligns with the principles of market abuse regulations that prohibit the disclosure of inside information to any other person, unless such disclosure is made in the normal exercise of employment, profession, or duties. By escalating the matter internally and seeking guidance, the individual demonstrates a commitment to upholding regulatory standards and protecting CSL from potential compliance breaches. This proactive step ensures that any decision regarding the information is made with full awareness of the legal and ethical implications. An incorrect approach that involves immediately sharing the information with the client, even if requested, will be a direct violation of insider trading regulations. This failure to recognize the potential materiality of the information and the prohibition against its disclosure would expose both the individual and CSL to significant regulatory penalties and reputational damage. Another incorrect approach, which is to disregard the information as insignificant without proper assessment, is equally problematic. This demonstrates a lack of due diligence and a failure to apply a robust decision-making framework when faced with potentially sensitive information. It could lead to inadvertent breaches of regulatory requirements. Finally, an approach that involves trading on the information before it becomes public would constitute illegal insider trading, a severe offense with substantial legal consequences. Professionals should employ a structured decision-making framework when encountering potentially sensitive information. This framework should include 1. Information assessment. Determine if the information is material and non-public. 2. Regulatory review. Consult relevant regulations and internal policies regarding disclosure and trading. 3. Risk evaluation. Assess the potential legal, ethical, and reputational risks of any action or inaction. 4. Internal consultation. Seek guidance from compliance, legal, or senior management. 5. Action. Take a course of action that is compliant, ethical, and minimizes risk, prioritizing regulatory adherence. Question 19. Implementation of a new investment product by CSL that offers a higher commission to CSL advisors, but carries a slightly higher risk profile for the client compared to existing, lower commission products, presents a potential conflict of interest. How should a CSL advisor ethically and regulatorily approach this situation when discussing the product with a prospective client? Option A. Proceed with recommending the new product without any specific disclosure regarding the commission structure or the nuanced risk differences, believing that the product's performance metrics are sufficient justification. Option B. Fully disclose the higher commission structure for CSL advisors and the slightly elevated risk profile to the client, explaining how the product aligns with their stated financial goals and risk tolerance, and obtain their informed consent before recommending it. Option C. Recommend the new product to the client, highlighting its potential benefits while omitting details about the higher commission for CSL advisors and downplaying the increased risk, assuming the client's primary interest is potential returns. Option D. Inform CSL management of the potential conflict and seek their guidance on how to present the product, but do not proactively disclose the commission structure or the specific risk increase to the client unless directly asked. The correct answer is B. Fully disclose the higher commission structure for CSL advisors and the slightly elevated risk profile to the client, explaining how the product aligns with their stated financial goals and risk tolerance, and obtain their informed consent before recommending it. Explanation. This scenario presents a professional challenge for CSL employees due to the inherent conflict between client interests and the firm's potential financial gain. Navigating this requires a deep understanding of regulatory obligations and ethical principles to ensure client trust and market integrity are maintained. The core difficulty lies in identifying and managing potential conflicts of interest that could compromise fair dealing. The correct approach involves proactively identifying and disclosing potential conflicts of interest to the client, seeking their informed consent before proceeding, and prioritizing the client's best interests above CSL's potential revenue. This aligns with the fundamental regulatory duty of care and the ethical imperative to act with integrity and in the best interests of clients, as mandated by the CSL hiring assessment tests governing framework. Transparency and client consent are paramount in mitigating risks and upholding professional standards. An incorrect approach that involves proceeding without full disclosure to the client, assuming the client would implicitly agree or that the potential benefit to CSL outweighs the need for explicit consent, fails to meet regulatory requirements for transparency and client protection. This could be construed as a breach of fiduciary duty and a violation of fair dealing principles. Another incorrect approach, which is to prioritize CSL's immediate revenue generation by downplaying or omitting the potential conflict to the client, directly contravenes the ethical obligation to act in the client's best interest. This approach risks significant regulatory sanctions and reputational damage for both the individual and CSL. Finally, an approach that involves seeking internal approval from management without informing the client about the conflict, even if management deems it acceptable, is insufficient. While internal processes are important, they do not absolve the employee of their direct responsibility to the client and the regulatory framework that mandates disclosure and consent for material conflicts. Professionals should employ a decision-making framework that begins with identifying any potential conflict of interest. This involves considering the interests of all parties involved and assessing whether CSL's interests could improperly influence the advice or services provided to the client. If a conflict is identified, the next step is to evaluate its materiality. If material, the regulatory and ethical obligation is to disclose the nature of the conflict to the client clearly and comprehensively, explain the potential implications, and obtain their informed consent before proceeding. If consent cannot be obtained, or if the conflict is too significant to manage, the professional should consider whether it is appropriate to continue with the engagement. Question 20. Governance review demonstrates that CSL is considering the development of a novel financial product designed to offer enhanced returns to sophisticated investors. While the product's potential profitability is high, its structure is complex and may introduce new forms of market risk. CSL's senior management is eager to launch this product quickly to capture market share. What is the most appropriate course of action for CSL to ensure regulatory compliance and ethical conduct during the development and launch of this new product? Option A. Conduct a thorough, documented compliance review involving CSL's legal and compliance departments, assessing all potential regulatory risks and ensuring adherence to CSL's internal policies and relevant regulatory frameworks before proceeding with the launch. Option B. Proceed with the product development and launch, assuming that the product's complexity is understood by sophisticated investors and that any regulatory issues can be addressed post-launch. Option C. Prioritize the speed of market entry and launch the product immediately, with a plan to engage the compliance department only if regulatory concerns are raised by external parties. Option D. Rely on the product development team's internal assessment of compliance, as they are most familiar with the product's technical specifications and intended market. The correct answer is B. Proceed with the product development and launch, assuming that the product's complexity is understood by sophisticated investors and that any regulatory issues can be addressed post-launch. Explanation: this scenario presents a professional challenge due to the inherent conflict between a firm's commercial interests and its regulatory obligations to protect client assets and maintain market integrity. The firm, CSL, must navigate the complexities of its fiduciary duties while also pursuing profitable business opportunities. Careful judgment is required to ensure that any new product development or service offering aligns with regulatory expectations and ethical standards, preventing potential conflicts of interest or market abuse. The correct approach involves a proactive and comprehensive assessment of the new product's compliance with all relevant CSL policies, industry best practices, and the specific regulatory framework governing financial services in its jurisdiction. This includes a thorough risk assessment, clear documentation of the compliance process, and obtaining necessary approvals from the compliance and legal departments before launch. This approach is correct because it prioritizes regulatory adherence and client protection, which are fundamental to CSL's license to operate and its reputation. It demonstrates a commitment to a robust compliance culture, ensuring that new ventures do not inadvertently expose the firm or its clients to undue risk or regulatory breaches. An incorrect approach would be to proceed with the product launch without a formal, documented compliance review. This fails to uphold CSL's responsibility to ensure its operations are conducted in accordance with regulatory requirements. It creates a significant risk of regulatory sanctions, fines, and reputational damage. Another incorrect approach would be to rely solely on the product development team's internal assessment of compliance, bypassing the independent oversight of the compliance and legal departments. This undermines the principle of independent oversight and the segregation of duties, which are critical for effective risk management and regulatory compliance. It also fails to leverage the specialized expertise within CSL dedicated to interpreting and applying complex regulations. A third incorrect approach would be to launch the product with a vague understanding of potential regulatory implications, assuming that any issues can be addressed retrospectively. This demonstrates a disregard for the proactive nature of regulatory compliance and the potential for serious consequences if a breach occurs. Professionals should adopt a decision-making framework that begins with identifying potential regulatory implications of any new business initiative. This should be followed by a structured process of risk assessment and compliance evaluation, involving all relevant internal stakeholders, particularly the compliance and legal departments. Transparency, thorough documentation, and adherence to established internal policies and procedures are paramount. When in doubt, seeking clarification from regulatory bodies or external legal counsel is a prudent step. The ultimate goal is to ensure that business objectives are pursued within a framework of strict regulatory compliance and ethical conduct.